America is $36 trillion in debt, but that's only the beginning. America's national debt has soared past $36 trillion, a figure so massive it's nearly impossible to visualize. Yet every dollar of that debt is owed to someone. People often point to China as the biggest lender. And yes, China holds around $750 billion in US debt. But here's the twist. China itself is buried under more than $18 trillion in debt. So who holds China's debt? A large portion is owned by Chinese banks. But those same banks also hold US debt. And American banks? They own debt from China, Europe, practically everyone. It's a tangled web. Every country is borrowing, every country is lending. And together, the world now owes more than $300 trillion. That's 3 times the size of the entire global economy. So if the world owes $300 trillion, who is it all owed to? It sounds like a simple question, but the answer is surprisingly complex. It's not just an accounting illusion, it's a glimpse into how the modern world truly works. The truth is this, the global economy isn't built on stability. It's built on movement, an endless cycle of borrowing, lending, and reinvesting. Debt isn't new, it's ancient. While debt feels like a modern problem, it's actually one of humanity's oldest tools. Long before money or banks existed, debt was just a promise. You lent your neighbor a sack of grain in the spring, and come harvest, they paid you back, maybe with a little extra as a thank you. No banks. No interest rates. Just trust. Over time, that simple concept scaled up. Kings needed castles. Empires needed cannons. But no single lender could foot the bill. So in 17th century England, King Charles II introduced a radical idea. He sold debt to the public. In exchange for cash, citizens got bonds, promises of repayment with interest. This changed everything. Governments could now fund wars, build infrastructure, and expand economies without draining their treasuries. And by the 20th century, bonds had gone global. From gold to paper and the rise of fiat debt. After World War II, the Bretton Woods Agreement made the US dollar the anchor of the global financial system. Currencies were tied to the dollar. The dollar was tied to gold. But gold was finite. Economies needed to grow. So in 1971, President Nixon severed the gold-dollar link. The world entered the age of fiat money, currency backed not by metal, but by trust. Now, governments could borrow and print money freely. And they did. From the 1980s onward, debt skyrocketed. Governments borrowed not just for war, but to fund education, repair roads, and stimulate growth. Debt stopped being a backup plan. It became the plan. Today, debt is the lifeblood of modern economies. It funds development, absorbs crises, and keeps promises. But it's also growing faster than ever. The global debt mountain now stands at $300 trillion. To grasp how enormous that is, a stack of $1 million in bills is the height of a 30-story building. $1 billion would reach the edge of space. $300 trillion could take you to the moon and back 50 times. Who's owed what? It's a loop, not a line. Let's zoom in on the US, the world's most indebted nation. Who lends the US that much money? Surprisingly, around 70% of US debt is owed to Americans themselves. When you deposit money in a bank, it doesn't sit idle. Banks invest it. One of the safest investments? US Treasury bonds. As of 2025, US banks hold nearly $1.8 trillion in government bonds, more than the GDP of Brazil or Canada. Bonds are attractive because they're stable. They pay steady interest and don't swing like the stock market. A 10-year Treasury bond might yield 4.5% annually, a safe return with minimal risk. That's why banks, pension funds, insurance companies, and investment firms all pile into bonds. It creates a self-reinforcing system. You save money. Your bank buys bonds. The government uses that money to fund the economy. Interest payments go back to your bank and to you. You earn more, save more, and buy more bonds. This cycle doesn't just happen inside countries. It happens across borders. Japan's savings fund, Dutch loans. Dutch savings fund, Brazilian projects. Brazilian capital flows back into US bonds. It's not a global pile of unpaid bills. It's a circular ecosystem. But what happens if the cycle breaks? Governments rarely pay off their debt. Instead, they borrow new money to repay old loans. It's continuous. It works as long as people keep lending. But if borrowing stops, the system crashes. Take Greece during the 2008 crisis. When investors stopped buying its bonds, the government ran out of money. 1 in 4 public workers lost their jobs. Wages collapsed. GDP shrank by 25%. No politician wins elections by promising austerity. Voters want spending, and spending means borrowing. In 2020, when COVID shut down economies, governments had no choice. The US borrowed $3.8 trillion, nearly 20% of its entire GDP, just to stay afloat. So did China. So did Europe. But remember, every borrowed dollar must be repaid. And if revenue isn't enough, governments borrow more. In rich countries like Germany or Switzerland, this is manageable. They borrow at low rates. But developing nations pay dearly. Countries like Sri Lanka and Pakistan are stuck in a debt trap, borrowing just to make interest payments. The debt eats itself. Can we just stop borrowing? Not really. Because debt fuels growth. Government borrowing funds projects, creates jobs, and keeps money circulating. In China, nearly 1 in every 5 yuan spent is borrowed. In the US, it's about 1 in 4, the same as what's spent on education and welfare combined. If borrowing stopped, spending would drop. Jobs would vanish. Growth would reverse. But growing debt carries risk, especially rising interest payments. Today, many countries spend more on interest than on schools or hospitals. A 100% debt to GDP ratio is now considered normal, something once seen as catastrophic. And when investors grow nervous, interest rates spike. Borrowing gets more expensive. Governments might try to print money, but that fuels inflation. In extreme cases, it destroys entire economies. When inflation explodes, Venezuela's cautionary tale. In the late 2010s, Venezuela printed so much money to cover its debts that prices doubled every few weeks. Bread cost millions. The currency collapsed. Life savings vanished overnight. Even moderate inflation can hurt, especially for countries borrowing in foreign currencies. If their own currency weakens, repayments become more expensive. Investors lose trust. Rates go up. The cycle becomes toxic. Eventually, some nations default. They simply can't pay. It's the economic equivalent of a mortgage foreclosure, except the whole country goes down with it. That's why people are turning to gold. In times of uncertainty, investors look for something real. And that's what we're seeing in 2025. Gold is up nearly 28% this year. The US dollar is down 9%. Silver just hit a 30-year high. Gold mining stocks like the GDXJ index have soared 45%. Even big banks are bullish. Bet Morgan sees gold reaching $4,000 by mid-2026. Goldman Sachs and Bank of America agree. One standout is Gold Mining Inc., GLDG. Despite gold prices hitting highs, this company is trading at prices last seen in 2018, when gold was worth half as much. GLDG owns one of the largest untapped portfolios of gold and copper projects in the Americas, across 5 countries. It has over 21.5 million ounces of gold-equivalent resources. Its portfolio of publicly traded assets and cash is worth more than its current market cap. Insiders, including top executives and institutions like BlackRock, UBS, and Goldman Sachs, hold millions of shares. And right now, the stock trades at just 76 cents as of June 12, 2025. If you're looking for a company with real leverage to gold's price and a long-term development plan, GLDG may be worth a closer look.